Good evening, everyone. I'm Berkeley's Vice Mayor, Susan Wengraf, and I want to welcome you all to this webinar about the insurance crisis that we are all currently experiencing. The goal of tonight's webinar is to inform and educate us all about why this is happening, how we can best deal with it in the short term, and to learn more about the proposals that are on the table for long-term solutions. I've received hundreds of phone calls and emails about people receiving notification from their insurers of non-renewal of their homeowner's policy. As a result, homeowners are feeling frightened, confused, and angry. We're very fortunate to have an esteemed panel of experts with us tonight, representing different agencies and organizations with varying opinions on different aspects of this issue. I thought that hearing a diverse group would be the most informative for all our attendees. I want to remind everyone to be respectful of the divergent views that we might hear tonight. Now for some housekeeping. The webinar will be structured as follows. We'll have introductions from our panelists, then we'll have questions to the panel, then audience questions, and a brief wrap-up. I've prepared several broad questions for our panelists based on my own research and conversations with constituents, colleagues, and people in the field. After our panel discussion, we will take questions from attendees. You can use the Q&A icon function at the bottom of your Zoom screen to send us your questions if they weren't covered in the first part of the webinar. Please be as clear and concise as possible when drafting your question. My aide, Lori McWhorter, will read the questions so that everyone can hear them. We will try to take all your questions, but we're scheduled to conclude by 9 p.m. We're recording this webinar and we'll make it available early next week. Everyone who signed up will receive a link, and please feel free to pass that link on to neighbors and friends who are not able to attend tonight. I'll also include the link in my next newsletter. We currently have about 680 attendees joining us tonight. I want to acknowledge that Berkeley's Mayor Jesse Ardegine and Council members Humbert and Hahn are also joining us. And now I'd like to ask the panelists to turn on their cameras and unmute. And please introduce yourself when I recognize you. Okay, Amy, can you
good evening.
introduce yourself?
Good evening, registrants. My name is Amy Bach. I am the co-founder and executive director of the nonprofit United Policyholders. I have been a career-long insurance consumer advocate for going on 35 years, and my organization is hard at work helping you figure out why this is happening and how you can continue to protect your assets. And our website has all kinds of free information, and I'm so pleased to be part of the panel tonight.
Thank you, Amy. Okay, Karl Susman.
Hi, thank you. I'm Karl Susman. I'm an independent insurance broker and agency owner. I also work as an insurance expert witness in complex litigation cases, and I host the only hour-long syndicated radio show in California about consumers and insurance. I'm licensed in about 30 states, and I hold a master's in insurance management. I'm an insurance guy. I've been dealing with this insurance market for the last several years and watching it decay, and I'm finding it more and more challenging to do what it is that I do, which is trying to find coverage for clients. So I appreciate you taking the time to come tonight and hopefully pick up some information on how to help yourselves during this tough time.
Thank you, Karl. Carmen.
Good evening. Thanks for inviting me, Susan. My name's Carmen Balber. I'm the Executive Director of Consumer Watchdog. We are a consumer organization focused on many things, but insurance was our founding. Our founder, Harvey Rosenfield, wrote California's Proposition 103 in 1988, which regulated insurance in California. It had not been regulated prior to that in any meaningful sense. And that law requires insurance companies to open their books, justify their rates, and get approval for rate increases before they take effect. Its transparency provisions have been the cornerstone of keeping rates reasonable in California, although every homeowner can now attest that those controls are out of whack. So we're really thrilled to talk here about today about solutions. Thanks.
Thank you, Carmen. Okay, we'll go now to Colin Arnold.
Thank you, Vice Mayor. My name is Colin Arnold. I'm the interim assistant fire chief in charge of the Wildland urban interface for the city of Berkeley. I've been with the city for about 16 years. This is a fairly new assignment to me, but I'm pretty well versed in some of the challenges that residents here in Berkeley are facing of a number of different things that we do. One of the things we're responsible for is all of the defensible space inspections and the home hardening recommendations that are delivered to over 8,000 homes here in the very high fire danger zone in Berkeley. So if you've got one of those door hangers from us or an inspection report, that would be my office. So pleasure to be here, and thanks a lot for having me.
Thank you, Colin. Okay, Julia.
Hello, Vice Mayor. My name is Julia. I am with thank you. I am Deputy Commissioner for the Community Relations and Outreach in the California Department of Insurance. It is my pleasure to be here today. My main job with the department is to ensure that we are listening to our consumers and that we are meeting with as many people as possible so that they know how to contact the department when they have any type of issue, and then also gathering information that then educates the department as well on the solutions that we are seeking. So this last year, our department has actually held over 968 meetings, town halls like this, and events throughout the state, ensuring that we are listening, that we are engaged, and that we are informing the community and also the department on the major issues. So thank you very much for hosting us. It's a pleasure to be here.
Thank you, Carmen. Okay, and Phil Irwin.
Good evening. Thank you for having me. My name is Phil Irwin. I'm the public relations representative for the California Fair Plan, and my primary role is to be a broker liaison. So I work with the brokers, helping them training on our products and do webinars and really just do everything I can to be a resource for the many brokers that are part of the California Fair Plan. I'm also an active broker, so I have an insurance agency in El Dorado County, which sits 100% in the Wildland urban interface. So for the last 6 years, I think to the date of the Camp Fire, the Paradise Fire, I've spent the better part of every day talking to customers and brokers just about the different realities and options within these areas in this footprint. So happy to be a resource for everyone involved.
Thank you, Phil. Okay, we'll go to questions now. My first question is a very broad question, and I know how complex this issue is, and it's become more complex with climate change. So I'm going to just throw this question out, and if you would like to answer, just raise your hand. What is the current landscape for home insurance in California, and how did we get here? Amy. Unmute yourself, please.
Since I do spend a lot of time talking about that question, the current landscape is very, very painful for consumers in certain areas, a growing number of areas. It's been developing for quite some time, this problem. There's a lot of people working towards solutions. When it first started to manifest, we did think it was much more related to climate change. And over the years, I've started to really recognize that it's a lot more related to the technological tools that insurers are now using that have magnified risk for them to the point where they don't feel as comfortable taking on that risk, and they are looking to charge a lot more. And so we have a tension in how much more they should be allowed to charge, and whether, and then of course, now we know in hindsight that we are relying very heavily on the private sector to provide an essential service. And we're going to have to structure some new rules in order to really solve what's going on, and allow people to continue to be able to protect their homes, meet their mortgage obligations, and also reduce risk at the same time.
Thank you. Anybody else? Okay, Carl.
Hi, thanks. Just going right along with what Amy was saying, I think that it's actually a lot of consumers in higher fire risk areas. But in addition to that, the level of availability for property insurance policies, whether that's homeowners, condominium owners, even renters insurance policies, is next to non-existent statewide from the experience that I see. Anecdotally, it doesn't matter if someone's in the hills, in the flats, in the middle of the city. It's not as if we can just call a carrier or check with any of the standard markets and get a proposal for them. So it's not even just limited to the areas that one would think, well, these are the scary areas because they're in the hills or they're have this fire exposure. It really is the entire property insurance market that's affected, and it's even affecting the commercial insurance market as well. Remember, businesses, they burn too. And all the other factors that are contributing to some of this chaos that's going on is affecting other types of insurance as well as just homeowners policies.
Okay. And Carmen.
I would put that question, I mean, everything everyone said is exactly what I would say to start, but I would put it in a broader context, which is that we are experiencing and have been experiencing since the pandemic started massive cost changes in the market, not just in California, but across the country. We've seen huge inflation. We saw all of the crazy supply chain problems that roiled every market. Inflation has caused construction costs to go up, labor costs to go up, et cetera. And so all of those are real cost pressures that the insurance industry is feeling, like every other industry, and they're feeling it across the country. This is not a California-only situation. They also saw bigger than normal losses from their investments. And the insurance industry makes money not off the product they sell, but off their investments. And so that also put cost pressures on the industry. So we saw all of that happening in California on top of climate and everything else that Amy and Karl talked about. And we've also seen a unique circumstance in California, which is why we're on the tip of a spear. And I know we'll have a chance to talk about this later, but I do just want to start out the conversation by acknowledging that the insurance industry has seized on this moment, in our estimation, to go after a long-time goal, which is ratcheting down the insurance regulation that has kept Californians protected for many, many years, and that is a piece of the puzzle.
Okay, that's a great segue to my next question, which is, what about regulation in the state of California? Can somebody give us a brief history of regulation in California and where we are currently? Karl.
I feel like we're playing Jeopardy, like who's going to buzz in first. I think I got this one, right? It's a loaded question, right? California, I'm born and raised here, so I can say good and bad things about California, and I can get away with it because I've always been here. And California is the highest, most restricted area as far as insurance regulation goes countrywide. It's not a secret. It's not something that anyone will really argue about. And whether that's a good thing or a bad thing, people can debate. But California is sort of its own little world when it comes to how regulations are put into place and how the insurance industry is regulated in general. Other states, there are extremes. Just to put it in layman's terms, there are some states, for example, where an insurance company can do what's called file and run, where they basically file the rate they want and it's out the door the next day. That's one extreme. And then there are other states that have to get approval for everything, whether it be a rate or a discount or a new product. So there's this wide range of different types of regulation that exists across the country. And California, this is why we're seeing this so dramatically now. We're, of course, as we always are, we're an extreme, and we have the extreme end of the regulation right now that as Carmen mentioned, is something that's being dealt with right now.
Susan, you're muted.
What is the regulation that we currently have on the books in California?
Well, I wouldn't pretend to know all of them. There are a lot. Certainly Proposition 103 is one that everyone talks about because it did create things like an elected insurance commissioner and things like that. It did have an immediate effect of rolling back rates 20%. That was the actual selling point for the proposition, was lower your rates 20%. So that's obviously one of the main regulations that you'll hear about, but that's certainly not the only. I think it's 2 pages. It's not a huge piece of legislation, but it's the one that you hear the most about because it gets the most attention. But I've got a book somewhere I can show you. There's a book this big of different regulations that exist for California when it comes to the insurance industry, not just for insurance companies, but for how things are marketed in the insurance industry. And this extends to everything from property insurance to health insurance to everything else.
Julia, did you want to comment on this?
Sure, thank you. And one of the things about that is important to note is that for years, basically insurance companies would not request the rates that they actually needed. And so that has been a major issue because of our, of our process that we have with Prop 103. A lot of the rates largely just were stagnant because of the intervener process, because of the different processes that we have in place. That is just basically compressed. There were so many stresses that are just needed for reforms, and so neglected decisions just haven't been made around that. And so we are really looking at the department, working on and trying to survive on 20th century regulations is what Commissioner Lara says, for 21st century problems. And basically the whole issue of that is looking at really looking at insurance companies and asking exactly what it is that they need in order to be able to provide the services that they need to for consumers. And then, of course, the other thing is that insurance companies are not utilities. We can't make insurance companies sell us insurance, and so there is that pressure as well. So there are many issues here at play, and it is a very complex issue. And so that has been, that has added to that, to all of this as well. But I absolutely agree that it has been a lot of just everything just accumulated to a perfect storm, for the insurance industry as a whole. And then, of course, the department is working not just within the state, but we are actually, we're working with the National Association of Insurance Commissioners, because this is an issue that is not just California based. It is something that insurance companies are dealing with, and in states all over the country are dealing with. And so that is why it is pressing, and we are in the middle of all of these changes right now. But we are working on solutions, and so we are very hopeful on that as well. So I'm sure we're going to get to that.
We'll get to solutions later.
We will get to that.
I'm going to move to another question, and that is, how do insurance companies measure risk? What criteria do they use? And is the criteria standardized across companies? And I know that this is a complex question, but I think it's key to trying to figure out why some people are getting notices of non-renewal and others are not. So, Carmen?
So it's a really good question, and it ties a little bit back into the previous conversation as well. Number one, it's not standardized. Every single insurance company uses a different list of things that they rate people on, and we don't even know what many of them are because of those tools Amy mentioned, because insurance companies are using black box private models to make many decisions, including underwriting, whether or not they will sell to a homeowner, and what things they use to make the decision whether or not they'll sell to a homeowner, or what your price might be in that range. So, in the questions we discussed beforehand, you listed a lot of different things that insurance companies think about. They look at the age of your home. Some of them look at the vegetation around your house. Some of them look at how your home is constructed. Some of them look at the slope of your neighborhood or how close you are to a fire hydrant. But it varies company to company. And just jumping back for a second to that issue of regulation, one of the things that Prop 103 did was be very specific about how we regulate auto insurance. And that's because when it was enacted, we were having an auto insurance crisis, not a home insurance crisis. And it said 3 things that have to do with how you drive should be the top factors in your auto insurance rate. And it said all good drivers should get coverage. But we don't have the same list of protections in a home insurance market that, for instance, would say, if you do all the right things to protect your home from wildfire, you're guaranteed coverage. So we have a much looser oversight of the home insurance market. And that's something we think really needs to change, because insurance companies should be required to take all of those things into account and to be very transparent about how they're making those decisions for homeowners.
Amy?
So just to sort of restate and simplify what Carmen just said for the folks who've tuned in, I think people have probably figured this out. We regulate rates, but we don't regulate underwriting quite the way we regulate rates. So just as she just said, why people say, well, why did my neighbor get non-renewed and I kept mine, or the reverse? It's because insurers are pretty much free to choose their customers. And that has kind of been a bit of a third rail in the legislature. And there are a couple of proposals that are circulating right now that would say that an insurer must. But because they're so controversial, and insurers, we're sort of teetering a little bit. We're trying to hold insurers in the state right now. The department has taken the approach to say, okay, we've got the regulations in place now to say that they have to give you a discount for things that you do to make it less likely that your home will burn. But the bridge too far so far has been forcing insurers to take customers they don't want, with one exception. And we have a representative of the FAIR Plan here who can explain it more. But what California has in our FAIR Plan, it actually is a program that forces insurers to take a little bit of what they don't want with what they do want. So we have some of we have the raw materials to fix this, and we're on the road, but it's not happening fast enough, I think, for our stakeholders. And we do need some longer term changes.
Thank you. Carl?
Yeah, I just wanted to clarify something. I wasn't sure if it came out right or not. There's this expression that comes up now and then. It seems to always bubble to the surface about black box secret underwriting and things of that nature. And what's actually going on, and it's more akin to the way Amy's explaining it, is there's regulations that go into how much an insurance company can charge, what they can't charge, what discounts they give, and how much they charge for those things. But there's no secret about how they're underwriting internally. Commissioner Latta put something out, and I'm sure Julia can speak to this, that says people have to be told if they're being rejected or non-renewed, specifically what it is that they're being rejected or non-renewed for. The analogy I always use is that the insurance carriers will tell you, this is a hamburger and it's got, a bun and meat and sauce and all this stuff. And that's public knowledge and everybody can know that. What they don't do is they're not going to tell you, well, what's in that sauce exactly? And where did you get the beef? Is that, was it grown, from farm-raised cattle or not? And how long do you toast the bun? There is an element of privacy, obviously, because these are private companies that don't want to share their specific secret sauce with others. But as it comes down to consumers, and I can tell you this from personal experience dealing with consumers every day, if someone is getting a non-renewal or someone is not eligible for a policy, the insurance carriers absolutely have to tell them why. I'm never in a situation where a carrier is non-renewing or not accepting, and the client says, well, why? And I say, I don't know. I mean, they have to tell us if we ask. So I think it's a little bit of education that some consumers might not realize they have that power, that they can ask, and they will get the answer to that question. And I think the regulations that are coming out later are actually amplifying that even more so.
So people may get a letter that says you're being canceled because we've determined that the risk of living in a very high hazard fire zone is too great. Or you're being canceled because we have determined that the density of housing in your area exceeds our standards for coverage. But there's really nothing that the homeowner can do about that. They live where they live.
Well, that's the beauty of competition. I always use Palm Springs as an example. There are insurance companies that think Palm Springs is the worst exposure for earthquakes, the worst possible. They never want to write earthquake insurance there, and they price it accordingly. And I have other companies that think it's the greatest place in the world. It's their least expensive area to write earthquake in. That's because they have different models. They're looking at things differently. So someone that would get a letter, for example, that says you're simply in an area that we find is too high of a risk for fire, that doesn't mean that another carrier might not look at them, and they often do, and say, well, we'll take that risk. And there are carriers called non-admitted companies now that are stepping in because the market is so tight, and they're writing a lot of that business. But the idea is that we know there are things that we can do, to your point, and things that we can't do. And if we can't do something, then we have to look to competition to try and hopefully find a carrier that's willing to take that risk. Or like Amy was saying, go to the California Fair Plan, which is backed by the insurance industry anyway. It's their money, and get coverage there. And if they're rejected or non-renewed for something they can do something about, then they are able to get the information on what it is they need to do in order to potentially remedy those situations to be able to maintain their policy or be able to purchase a new one.
Okay, in Berkeley, go ahead, Julia.
May I? Thank you. Thank you so much, Vice Mayor. I just wanted to add here, because one of the things that we hear from people is that they, for years, have been told your wildfire risk score is too high. And when you ask the insurance company, well, what is it? And how did you get to that? They would say to you, that's proprietary information and we can't really share it with you, right? So that had been the answer that they always gave. So through regulation, Commissioner Lara actually made it so that now you can ask insurance companies what your wildfire risk score is, and you can appeal that. When you look at, you look at it and they have to share it with you. They have to tell you what, how they came about that. And then you can appeal it because of all the work that you have done to mitigate your property, or if you have just different things that you can point to. And if you're not getting anywhere with your insurance company with that, the department has our 800 number where we have experts, insurance experts that are there available that they can contact the insurance company with you and walk you through the whole process to help you through that and ensure that either they acknowledge the work that you have done, or that they're able to sometimes even get you those discounts. I was just a quick note on this, around all of that. Commissioner Lara did put together the Safer from Wildfire framework with all of the different agencies that work with wildfire. And so there are very specific things that people can do. And so now you can really look through all of those things and work through that. And if you are in the FAIR plan, which I'm sure in your community, there's a lot of people that are most likely in the FAIR plan, Phil can probably, speak to that they do get their discounts for the work that they have been doing as well. So there is that, that is available right now for consumers.
So are you saying that the insurance companies will look at individual properties and determine what individual properties have to do in order to be eligible to be insured?
If you ask for, if they tell you your wildfire risk score is too high and or you haven't done enough, yes, they will go through your property. Now, I was actually in Napa about a few months ago, having this conversation with consumers, and a couple raised their hand and said, I can absolutely tell you that this is true because it has actually happened to us. We did everything that we needed to do around our home, and we got a $1,200 discount in our insurance immediately. And so, we work with our fire department, with our local fire department, and, maybe Colin can talk a little bit more about what is available in your community for that, but it is very much so something that they can actually do and work with their local fire department, and then work with their local broker or their insurance agent, and make sure that they are able to show that to the insurance company so that they can take those into consideration.
Thank you. Colin, maybe you could give us a little background about how wildfires have changed in the last maybe 10 years and why the risk has increased, or how the risk has increased.
Sure. I think one thing that I think is important to remember is that wildfires have been a part of the California landscape since before there's European settlement here. And we've got evidence of those fires from pre-modern times. I think probably most people on this call are familiar with the federal policy and state policy of mitigating all wildfires in the forest in California and keeping them to sometimes less than 10 acres for decades. I think we saw wildfires as a threat, decided the best thing to do was put them out, and in doing so left a huge amount of unburned fuel in these forests. The other major thing that has changed in the last 20 to 30 years, or maybe 50 years, has been a drive for housing in the wildland urban interface. So we're seeing a real push by residents who really enjoy living in parts of this state that are absolutely gorgeous, beautiful views, woody surroundings, peaceful nature, but also exposing themselves more to that hazard. So climate change is that third piece that exacerbates the existing threat. Climate change is not causing wildfires, but climate change is basically an accelerant. It's shortening our rainy season, it's lengthening our dry season. There are days when we are getting lower humidity than we would have 20, 30, 50 years ago. And those days make the wildfire threat more severe. I think a combination of those factors is driving a fire picture for us that is more aggressive than what we historically had modeled. The combination of heavy fuels, lack of long-term mitigation of fuels, more homes in those environments, and a longer dry season. Put that together and we have some of the explanation for some of the large fires that we're seeing, and including fires that have spread from the wildland urban interface further into communities. And ended up threatening homes that traditionally would not have been considered part of the wildland urban interface.
Thank you. Well, it's music to my ears, and I think to Colin's ears as well, that there's a nexus between doing work on your property and being able to keep your insurance. Because we in Berkeley have been working very hard to educate people about the value of home hardening and defensible space. And if we could tell them, if you do this, you will get insurance, you won't be canceled or non-renewed, you won't receive a notice of non-renewal, then they would have a wonderful incentive for doing that work, and we would be a much safer community. So that is really great to hear. Carmen, your hand is up. Did you want to add to that?
I just wanted to speak to that because I think some of your constituents are going to be scratching their heads and saying, wait, I did everything in my insurance company, still canceled me. So what is going on? And I think it's important to go back to what the department did with the Safer from Wildfire standards. They set out a set of 10 individual and 2 community steps that you can do, and your insurance company must give you discounts for them. All of those discounts aren't approved yet, so your insurance companies might not be done yet. And frankly, some of the insurance companies are offering discounts that are laughable. The amounts are wiped out by the amount that they want to charge you to get your home certified. So it definitely varies how insurance companies are offering those discounts. Number 2, there still is no requirement that they cover you if they do all these things. So the big loophole in that regulation is a mandate that you get coverage if you take those steps. So you could still be canceled. That's not to say that a different insurance company won't say, oh yes, you did all those things and we do want to cover those people. But I just want to make sure that the folks listening don't say, they said I have a right. How come my insurance company canceled me? Because we don't have that protection. And we'll get to solutions, but that's what we are urging folks to ask lawmakers to do.
Amy?
So yeah, we do, as I said earlier, there are a couple of proposals that would force insurers to, to sell a policy to somebody or renew a policy to somebody who's done the work. And I think at some point that one of those proposals is probably going to become law. But as we are now in the here and now, my organization, for one thing, we have a resource center where you can go the WRAP, it's called the Wildfire Risk Reduction and Asset Protection Program. You can go on there and you can put your county in and you can see who's offering grants and who's offering assistance to reduce risk. And we are starting to see insurers coming around. It's been a long road and we have a long way to go, but we are starting to see, USAA had been offering a 5% discount for years if you live in a fire-wise area. 5% is not going to really move the needle financially for a household. We are looking for things like the Fair Plan discount, which is now approved to be 15%. And we are getting more insurers what we want to see is for them to compete and say, we offer the best mitigation discount or, that kind of thing. And I think we will get there, but it's probably going to take longer than people would like. And that's the bottom line.
Okay. So one question that has really stumped me doing research on this is that the banks have been silent. I haven't heard anything from a bank about this whole thing. Yet the banks hold the paper on most of the property that's being impacted. And you can't have a mortgage without insurance. Does anybody on the panel have any insight into where the banks are on this and why they haven't voiced their opinion?
I can speak to it, but I'm sure there's other people who can as well. I'll just say there is a product, force-placed, lender-placed insurance, and we are worrying a lot that people who cannot afford the premium are letting their insurance lapse, and their lender is force-placing, and force-placed policies are not good. They really only cover the bank's interest in the loan amount. They don't cover you fully or give you the money you need to rebuild. So we are definitely cautioning people, please don't go there. But I have been talking to lenders about, well, couldn't you come up with a product? Could you, could there be something new? Could we fine tune force-placed policies? And they don't seem interested, at least not what I know. There's a fight going on right now on the federal level. Fannie Mae, which buys all the loans, has a rule that if they issue a loan or they buy a loan and it's with a federally backed bank, then there must be insurance in place, right? And they have been requiring that insurance be replacement value. So your constituents who went through the fire know a lot of people who go through a wildfire find out they don't have enough insurance. So insurers are saying, we need to skinny down coverage. So far, Fannie Mae is saying, no, not so fast. It needs to be replacement. This is a fight that's going on at the federal level. That seems to be where the lenders are paying attention. I don't know that they are what I'd like to see the lenders, just like you. I'd love to see the lenders coming to the table and say, hey, okay, if the private insurers have lost their appetite here, we have an idea. Here's a product. We haven't seen that yet.
Karl?
Well, I think the banks are absolutely speaking, and they're speaking by not giving loans. It doesn't have it. Unfortunately, it's not unheard of anymore. It's fairly too common, if you ask me, that homes will be in escrow and they will fall out of escrow because they literally are not able to get insurance to cover the property, or the cost of the insurance is so expensive, the loan to value gets skewed, and then the escrow falls off. I think I talked with 2 or 3 reporters one at Bloomberg and one at the Wall Street Journal about this very issue about escrows and insurance. So I think the banks are they're waiting because they know they really hold the keys to the castle, right? If we can't get a loan, we can't sell a house, right? And so they're basically the ones that are keeping things from progressing. If they were able to, they're obviously not going to give a loan out if their collateral is not protected by insurance, right? We know that. And I'm not entirely surprised that they haven't come up with some magic to be able to have a competing product either. I mean, if the industry can't figure out something, I'd be shocked if a bank all of a sudden comes up with a better mousetrap. But I think that what we're seeing is they're definitely speaking. They're speaking with their wallets by not giving out the loans that we want to have.
Okay, thank you. So there's been a lot of reference to the FAIR Plan, and I wonder now if, Phil, you might be able to explain to the audience, what is the FAIR Plan? How is it financed? What are the advantages and disadvantages of the FAIR plan? And what is the future of the FAIR plan given the enormous demand?
Those are all some really great questions, and I'm happy to answer them. Well, so to start off, the FAIR plan was established following the riots and brush fires of the late 1960s to ensure the availability of basic property insurance to consumers when coverage in the voluntary market is unavailable. The FAIR plan is a private association comprised of all insurers licensed to write property insurance in California and is funded primarily through the policies it sells to customers. By statute and with the approval of the California Department of Insurance, if the FAIR plan does not have the sufficient funds to pay all claims, it has the right to issue an assessment to all property insurers admitted to do business in California. The FAIR plan is required by law to have actuarially sound rates, which means that the FAIR plan rates must be sufficient to cover expenses and projected losses. FAIR plan rates are regulated by the California Department of Insurance. If the FAIR plan does not have enough funds in reserve to pay claims, which could occur following a catastrophic loss event, then the assessment of insurance companies would kick in following approval by the California Department of Insurance. So just moving on to the advantages and disadvantages of the FAIR plan, the FAIR plan is there to provide basic insurance for Californians unable to obtain insurance from the voluntary market. We want consumers to have choices in the insurance marketplace, but if they don't have the FAIR plan, the FAIR plan will be there for them. So, and again, the future of the FAIR plan, I think that was another question you asked too, given the demand. So it's a great question. As you know, the FAIR plan is experiencing significant growth and has been on a hiring spree to meet the growing demand. The FAIR plan is intended to be a temporary safety option for consumers until they can find coverage in the insurance marketplace. We hope that the marketplace will stabilize soon, so consumers will have additional choices for coverage.
So it's interesting. I just got an email today from a constituent who told me that his insurer said that he would be insured only if he also got the FAIR plan. So it's almost like health insurance where you have a secondary insurer. So in other words, people are now having to have two policies, which would I imagine would be a lot of money, a great expense. So they're using the FAIR plan basically as a safety net. Is that correct, Phil?
Correct. Again, it's referred to as the insurer of last resort when nothing else is available for a particular consumer, and it really comes down to, it's important that it's based on what's available in the market versus what's necessarily available with the particular company or broker they're working with. They really want to look far and wide, but it's intended to be the last option. That's the last stop. Then nothing's available, then the FAIR plan would be there and available for them.
It's interesting. I always thought the FAIR plan was financed by the state. And I just recently learned that it's financed by insurance companies. I think it's because it's called the California FAIR Plan.
Mm-hmm.
I assumed that it was a state program. Oh, thanks, Phil, for that. Julia, did you want to add?
Yes, I did. Thank you. And, one of the things that we always hear, we do hear from consumers saying, it's like, well, it's the state. And it is not. It's a program run by the insurance companies. The insurance companies are the ones that make all the decisions for the FAIR plan. And ultimately, the reason for it, and truly, and we hear from people all the time, it is so expensive. It was set up so that you were only supposed to be in there for maybe a few months while you looked for different insurance, while you found your insurance. And so all it is only insurance for fire, for wildfire risk. So you still have to, as a homeowner, you have to find then just wraparound insurance, difference in conditions insurance. So that is why you have to have two policies. You have to have the FAIR plan and a difference in conditions policy. Now, Commissioner Lara had requested the FAIR plan to to basically come up with a program where it would be just one insurance policy, and consumers would be able to just purchase that. Because of course, what we would see is that, you know, some insurance companies would say, we won't cover you for the whole thing, but we'll sell you the secondary insurance. And when at the end of the day, then, you know, you would have to pay the fees to the FAIR Plan and the fees to the secondary insurance. So there's all these other extra things that consumers had to purchase. So what you know, the FAIR Plan, we have been in litigation with the FAIR Plan for quite some time, and ultimately the FAIR Plan has agreed that they will be providing that that insurance. But it will be, you know, it would still, they still have to come up with that and work through it to try to make that a possibility for consumers. But that is the reason why consumers, you know, it is so expensive, and it is not supposed to be something that you're there for more than a few months, let alone years, as we have seen so many people, unfortunately, at this time, you know, on it.
Amy, did you want to?
So right now, yep, if you get a FAIR Plan policy, United Policyholders, you know, advises people, if you can afford it, you want to buy something called a difference in conditions, which gives you the full coverage while we wait for the FAIR Plan to comply with the commissioner's order and the court's order. But the reality is, you know, that we do need some longer term solutions, because as you know, your constituents, if they want to have earthquake insurance, they have to buy a separate policy. If they want to have flood insurance, they have to buy a separate policy. And, you know, Adam Schiff has introduced a measure in Congress. It's a long shot. It's probably not going to happen in our lifetime, or it might get amended significantly. But it's got some core pieces that I think your constituents would be interested in. It's the Insure Act, and it says that if that an insurer would need to sell an all-risk policy, right, covering all the hazards, and in exchange for that, they will be able to buy a certain amount of reinsurance, which is sort of the catastrophic risk, you know, ability to meet your obligations if something huge happens. And then also it has a whole mitigation component. So there are some ideas floating around to try to kind of fix this, because where we are now, it's very hard for the average consumer to protect their assets, you know, significantly. I mean, I think, you know, 90% of Californians don't have earthquake insurance. I think 98% of Californians don't have flood insurance. So we do have some work to do, you know, to really come up with a better way for people to be financially safe. But for now, we do have this patch product.
So that's a great way to transition to a discussion about solutions and what's on the table now, what's in the pipeline, what is the timeline for seeing some relief from this crisis. Who would like to speak to that? Julia.
Happy to start tackling it. So Commissioner Lara in November introduced a sustainable insurance strategy, which is basically the continuation of the work that we started doing with the Safer from Wildfires, and getting everybody on the table to try to figure out how do we work on this together. And one of the big, you know, the very big things that we're looking at is working on catastrophe modeling regulation. Because, you know, basically cat modeling is a way for insurance companies that many of them have been using at some point, but we are working to figure out what is the best way to work with that with you know, in California. And we're basically looking at allowing insurance companies to use that, because then that will allow them to be able to look at a property very granular. Right now we are seeing and you know, for years we have seen insurance companies say, okay, this entire zip code is not feasible for us. There's too much risk in this entire risk, and they would just get rid of the entire zip codes, right? So the expectation is that by insurance companies being able to look at, you know, using these models, looking at the actual risk. So not, you know, in the past, we have California has only looked at insurance risk by historical. So just looking at the last 10 years as to what has been the losses and how do we and so then looking at, okay, well then you should be able to charge this because of these losses for the last 10 years. Well, that is no longer feasible, as Amy had mentioned before. And it's like there are new things that insurance companies are using, and that we need to be able to then bring the state up to speed, so that we are able to also look at help consumers be able to actually get the right pricing. So if you have done all of the work to mitigate your home, for them to be able to look at that and then say, okay, this is how much you should be charged now because of the work that you have done. So that is the expectation around catastrophe modeling. So we are working on the regulation right now. We the commissioner has put all of this together, expecting that the department will get everything done by the end of the year, so that we are that we're moving all of this very quickly. As you know, and everyone knows, government works extraordinarily slow in the best of cases. And so what, when Governor Newsom came on board and said, this is a crisis, we need to do something about this, let's work on this together. It really moved the department to get everything that the department needs. So we are working on getting the right people in the right places to start working on not only catastrophe modeling, but we're also working on reinsurance regulation. California is one of the only departments in the country that one of the few that didn't allow insurance companies to charge to take into account how much they're spending on reinsurance, which is basically insurance for insurance companies, in their books. And so what we're looking at is trying to understand, how do we make sure that if we allow insurance companies to do this, that they really take into account California risk and only California risk, that consumers are paying for only California risk, not necessarily for, we know that insurance companies are conglomerates, that they work around the world, not just in the United States. And so very much so trying to figure out how do we make sure that the risk that they are calculating is going to be California only risk, and that consumers are only paying for that as well. Then we're also working with a FAIR plan to help modernize the FAIR plan, helping to, just the plan of operations to help increase coverage limits, because we know in the state, when Commissioner Lara came on board in 2019, we had to ask for the FAIR plan to actually increase the availability of insurance that they would cover for homeowners from 1.5 million to 3 million. And for businesses from 3.5 million to 7 million. What we have seen is that the need for that has increased tremendously. And so we are working with the FAIR plan as well to help provide $20 million, particularly for those businesses that are like HOAs that have different buildings that need a lot more than the 7 million that was available. So we increased that already in actually November, that was increased to 20 million. But now we're also looking at the FAIR plan to see, could we actually increase that to provide insurance for $20 million per building, so that those people that need it, those HOAs, those businesses that need it for those particular areas, that they're able to use that. We have also already, it's set up some regulations to basically require complete rate applications, so that when all participants, all of the insurance companies, when they're applying for their rate increases, that everything needs to be laid out and ready to go, so that we can actually move things along. It just, sometimes it just took much longer for them to do that. And so we are expediting our rate filing process through all of this regulation. And of course, we are making sure that our transparency efforts are are in place so that the public can participate. We have all of these, we're doing the workshops, we are getting involved, getting people involved in this conversation. If you're interested in learning about this and how this is going to work, then you can go into our website and get those consumer alerts, get that information so that you know when these workshops are taking place and you can have a say in that. All of this is stuff that we are doing at the department, and the expectation and what we are saying is if insurance companies are going to then be able to use catastrophe modeling, they're going to be able to use reinsurance and all of that, that they have to then provide insurance in areas where we have the largest concentration of fair plan policies, so that we can make sure that the fair plan is decreased and people can go back into the general market. So the expectation is that 85% of those areas are going to be covered because of this. So insurance companies we're already seeing some movement. It's not as fast as we want. Of course, we want this to be happening immediately, but we do have some insurance companies that have already have been making some moves, and we know that Farmers is going to reopen several of its commercial coverage lines, so including the homeowners associations, apartments, and condominiums. So it is very much so a direct result of of the department approving their commercial rate filing, and so through that, they have been approved for 3 of the homeowner rate filings in the last year. So they are continuing to write homeowners policies across the state. Then we also know of Mercury Insurance that has learned about Tokyo Marine basically dropping a lot of their consumers, and so Mercury Insurance contacted the Department of Insurance immediately after this happened and said they were going to be working with those consumers to make sure that they are able to cover them, or at least as many of them as possible. So there is that movement already. CSAA, insurance exchanges, homeowners insurance, their rate filing was approved last week. And so we are continuing to work with them. And so they're going to then continue to provide homeowners policies under AAA Northern California brand. And then, of course, earlier this year, the AAA South has also are continuing to write policies in Southern California. And then as we're doing our workshops, as we're working through all of this, Allstate, excuse me, Allstate had an executive testify in the department saying that once catastrophe models are in place, that they are going to end its pause on new homeowners business in California. And so they're going to be beginning to write in every corner of the state when the strategy is implemented. So we have seen movement. We are seeing movement, not as fast.
Your estimate of time is by January 1? And then we're going to move. We have to move on, Julia. Yeah.
The expectation for the department to finish everything is the end of 2024. So January 1, all of the things that the department has to do to make this happen should be in place.
Okay, thank you. And I have one question about the catastrophic modeling. How do we know that the catastrophic modeling is accurate? And does anybody want to address that issue? Carmen?
Yeah, because I think that is really the most important piece of the puzzle, right? I mean, an algorithm can tell you anything. And the one consumers are perhaps most familiar with is credit scores. And most of us have finally gotten like a piece inside that box by getting the number of our credit score, but we still, and even sometimes a list of the things that companies are tracking for our credit score, but we still don't know how to change it. And that's after decades of legislation and regulation at the federal level to try to help consumers understand that score better. We have no such picture into how private catastrophe models make those decisions. And so, that's one of the things that we have really been focusing on as a solution, that if insurance companies want to use models to set rates, they need to be fair and accountable. We need to be able to test them for bias, and we need to be able to know how they're weighting the factors that they're putting into the model, how they got the end result. Frankly, we need to know the secret sauce. And so we've been urging the state to start construction of a state public model for wildfire catastrophes. That way insurance companies can have access to this brand new tool that they want to use, but we can be certain that it's accountable and it's treating consumers fairly. Otherwise, we'll be in a situation like we are today where the insurance company might say your fire risk is too high, and they might even say it's because you live in an area where the landscape is rated X, and also your house is 20 years old, but that's it. And that's not enough to explain to a consumer why their rate went up 100 or 200% and what they might do about it.
Okay, I know fire departments across the region are using catastrophic modeling to figure out the way they're going to mitigate wildfire risk. I'm wondering if there's any communication between fire departments and the insurance companies. Amy?
That's so important.
A lot. There's a lot of communication. In fact, CAL FIRE is using modeling. I mean, the reality is, look, consumer advocate, anybody who's a consumer advocate is going to have a lot of concern about CAT models because they are projections, right? They are guesses. They're fancy crystal ball type guesses, right? They're not just based on historical data of what we know has happened. However, we are in a new era, right? And insurers are using CAT models everywhere else across the country. So politically, this is a non-negotiable item for insurers to come back and start writing. And that's just how it is, you know, and I have asked the Rate Regulation Bureau at the department many times, do you guys think you can still do your job if the rate filings have CAT models? And they say, yes, as long as we're able to have help evaluating the integrity of the model. So I think everyone agrees a public model would be great. Even the insurers say that's okay. We want a benchmark. Florida has a public CAT model, very, very expensive. It's going to take a while to develop it. So I think everyone kind of agrees that would be good. The question is, I don't know that we can wait to develop that before we allow insurers to be able to do this because it is a condition for them of returning to the market. And obviously, because we don't have a plan B and the FAIR plan relies on there being admitted insurers doing business in the state, we kind of have to, I think, proceed with the experiment as much as we are worried about it.
Thank you. Okay, at this point, we're going to take a stretch. Everybody can shake their arms and kick their legs, and then we're going to go to questions from the attendees. I want to thank you all for your expertise and sharing your knowledge about this issue. I think so far it's been a really fascinating discussion. So Lori, my wonderful assistant, my legislative aide, is going to ask the questions so that everybody can hear them, and then we'll have answers. So everybody at home, just stretch a little bit, and maybe a minute, we'll get back to the program. Okay, if everybody could turn their cameras back on, we'll get going. Lori, I see that we have 82 questions from the audience.
Yeah, there's a few questions.
Yeah, so let's wait for everybody to come back on camera, and then you can ask them.
Great. Well, the first question is for Phil, so I could start with that if you want.
Good.
Okay. The question is, please explain how the California FAIR Plan works. Just so the average person who wants to get a plan, how does it work?
So from the very start of becoming a customer, is that?
I think so.
So I would say the best place to start is to make sure you've explored your options. So, I think traditionally we're accustomed to working with one broker, one company, and we get to a point where that company or that broker is now telling me that there's no longer an option for me to have insurance with that insurer. So I would encourage the consumer to do a diligent search with every carrier you can think of. Make sure that you turn over every stone before you end up getting to the point where the fair plan is your last option. So at that point, then you want to work with a broker. There's 54,000 registered brokers with the fair plan. So I would say I would look for somebody within your local area that you would feel comfortable with, that would know the dynamics with your specific market, and start having a conversation about the fair plan and what the process looks like, and ensure that it is actually there is nothing else available, and they would help you with the application process to apply for the policy. You want to talk through the fair plan is customizable, so you really want to understand each component of coverage that you're purchasing. Make sure your home is insured to value, and going through the process as you would with the traditional carrier, and then they're going to help you set up the fair plan. And again, the components that are not part of the fair plan. So the fair plan is a named peril policy, so there are some components that you may want coverage for, such as water damage, theft, or liability coverage. And that's where you'd also want to look at options for difference in conditions coverage. And again, there's many carriers that provide that coverage too, and there are some differences, some benefits with other companies too. So you really just want to look at that spectrum, and then more than anything, you want to get ahead of it. You should be getting your non-renewal notice early, 75 days out, and you really want to start planning. I would say most people that are in those markets that are impacted are planning even further out than that, and that's a wise thing to do. And you just want to take your time and really make sure that you're making every decision that makes sense, and you're absolutely at the point where nothing else is available.
Great, thank you. Here's the next question. Maybe this is for you, Colin. Can you talk about the value of defensible space and home hardening as a form of protection for your home?
Sure. Thanks for the question. I think we've spent a lot of time talking tonight about insurance being that sort of form of protection against wildfire. And I think it's also really important as a part of this conversation to note that there's a lot that we can be doing within our own properties as a form of insurance. We talked about the Safer from Wildfires framework. There's the IBHS standards. There is the California Building Code, which lags noticeably a few years behind some of those standards. And then there's also the defensible space requirements here in the city of Berkeley. All of these are actually really similar. And so when folks are actually out there pursuing homeowners insurance and trying to mitigate and trying to harden their homes, they are also at the same time not just trying to get insurance, but they're doing a pretty huge service to their own property. And I think when we talk about those two things, it's really important to point out the value of them. Defensible space is generally the vegetation around your home and making your home more resilient from direct flame impingement. And then there's home hardening, which is usually protecting your home from ember cast and embers that come sometimes 2 miles in front of a wildfire. And these recommendations are based in pretty sad science. A lot of them come on the heels of some pretty devastating fires. But insurance companies are using some of these same standards because they know the science behind them, and they know how important they are towards actually protecting your home. And so as we're working towards developing models for insurance that allow homes to be insurable, it's really important to point out that if you do take the time to harden your home, where you have the financial ability to do some of those changes, or the defensible space mitigation, which is oftentimes vegetation management, your home is far more protected from wildfire. And while an important part of this conversation is the financial investment that we make in our properties, I think it's also really important to point out, and I know there's a lot of members of local firewise communities on this call, that what defensible space and home hardening also offers is a protection of community. So our goal here is to keep these structures from ever burning in the first place, to never get to the point where we need insurance, and also to create that or maintain that sense of community that's so important to us. And so I would really urge folks that are on this call that are feeling lost, are scared, are not sure where to go next, are not sure what's going to happen with a problem that is out of their hands. I would really advocate that there are substantial measures within your power that you do have control over, that if taken in conjunction with your neighbors, makes a huge difference towards your resiliency in wildfire. And the last thing I would point out there is that it's really easy to talk about the big challenges, invasive species of trees like eucalyptus, or really large projects that we see when we're driving up and down the street, and we go, "Oh God, if that's there, what's the point of me doing the work?" And I would also say that the science is pretty clear that a lot of times you can mitigate devastation from wildfire without cutting down all the trees. And while some of those steps are really important in the long-term health of the community, in the meantime, there are very simple, very straightforward steps that you can do today that offer you really high levels of protection. We've talked about the Safe from Wildfires there and there. The city of Berkeley also has a website that I'm happy to share in the link, or it can be passed out later. That has a lot of the same information, but don't sit back in fear. And I would really urge folks to take the opportunity to be really aggressive about some of that mitigation.
Great, thank you, Colin. I saw one more hand. I'll just take one more person on this same topic. I saw you, Amy, first.
Yeah, well, just to say, just to say that when the IBHS put out their standards and Safer from Wildfires put out theirs, and they're very, very similar. The first thing we said was, do people have to do all those things, or could they just do some of those things? And, for us, I mean, as a consumer advocate, of course, we want people to get credit for doing anything, right? So there's the screening your vents, very, very important. The 5 feet, what the experts say is it's got to be everything. That's kind of the official line, is that you really need to do everything on the list. And the bottom line for insurers is they do need to see, or they want to see, the community level adoption. So, if those of you who are active on your Fire Safe Council, or in Firewise, thank you so much for all the time and effort you're putting in. And we know it's hard with your neighbors, because people do have that feeling of like, it's going to look ugly if I take all my beloved brush away. But as the fire chief was saying, you don't have to take out all the trees. You can limb them up so that there are not limbs touching the house. And there are a lot of things you can do that are not going to break your budget, but you got to do them if you're going to want to stay in this area. That's just the bottom line, and you want to keep your home insured.
Okay, great. Thank you. I'm going to do this. I'm going to do this one. It's kind of fun. It's in caps, and it says, "Excuse me, but my neighbors and I are part of a certified Firewise community, and we were still canceled. I have spent $20,000 on home hardening, and I was still canceled after receiving a discount, after being told that I might qualify for an individual homeowner's discount." Can someone speak to that one and maybe provide some advice, guidance, or a reality check? Anybody raising their hand?
I can't speak to the insurance, but I do have to say that that is what I'm talking about in terms of a community that has come together and done that mitigation as a region. A given house doing the work is not nearly as effective as a block or a collection of homes doing it. And I can't speak to whether they will get coverage, and I hope somebody else here can. I see Carmen's hand up. But I do have to say that regardless of whether that insurance is in place or not, a moving wildfire towards that area is much less likely to find ignition points in that community. And what ignition points it will find will probably self-extinguish much more likely than it will in other areas. So those types of communities are really important, regardless of whether you have insurance or not, in terms of protecting the investment of your home. And that I'll leave it to the actual answer to the question.
Thanks, Colin. That's a little bit of hope. I saw Carl's hand up, so can you address it?
Sure. It's always hard when you hear, a specific story to try and figure out, really unwind it and figure out what's going on. But I think one of the things that Julia said that stuck with me that probably applies here is the new regulations that are coming down make the industry able to be more granular on what they're doing. And part of the problem is right now that you may have done, I'm speaking to the all caps question, you might have done all of these things like you're supposed to, which is great. By the way, that might make your house just less likely to burn, which really is the goal at the end of the day, insurance aside. But what happens is, because the current regulations are such that the carrier can't look at just your house or just your neighbor's house and say, yeah, we want that one. If we have to, the way they are now, they have to take the whole zip code. How many times have you heard about the whole zip code goes? And you know that half the zip codes in the flats, half might be in the hills, half might be areas that are completely different risks than the others are. But right now they can't pick and choose. So hopefully when the sustainable insurance strategy regulations come down, from what I've read for them, it's going to give a lot more flexibility for carriers to be able to look at individual risks and underwrite them and price them specifically, to the extent where the work you're doing on your house will be rewarded by either a lower premium than even your next door neighbor, let alone being able to actually have coverage or not.
Okay, thank you. I'm going to go to a next question, even though I see hands. I think you might be able to get your points across in other questions. Here, the next question is, what are the alternatives for homeowners who are denied insurance renewals? Where do we go to find a substitute policy? My property is a 4-unit. I see Amy's hand.
After you added the piece about the 4-unit, I was going to lower my hand. That's a joke. Some of the people that are being hit the hardest are condos, multi-unit. So, which is why we were all kind of like, when farmers announced a few weeks ago that they're going to start writing those again, we were like, that's great. The non-admitted market, and I'm going to leave it to the two agents here, maybe to add to that.
I do want to, if you don't mind,
Sure.
just quickly do want to say, when you do receive a non-renewal, we do have in the department a list, an insurance finder tool that you can go through and try to find who might be writing insurance in your area, and all that kind of thing. But also, just want to make sure that, when you receive a non-renewal, that you start looking right there and then. Don't wait to, don't wait any longer. Look as quickly as you can. And then also, we get, we have our 800 number where agents can help you navigate those tools that we have on the website for that. But that's what they're there for. We're here to walk you through all of that, and so we don't leave that to the last minute, and then just work out. Let's see how we can help you find that. We have our top 10 tips for looking for insurance too in our website that you can go through and look at that. And I know Amy has a lot of resources as well at United Policyholders that you can find information.
Wonderful. Wonderful. Can you say your 1-800 number out loud? I have several questions desiring it. You're muted now, though. Still muted.
I am sorry about that. Here. Okay. I apologize for that. But I will also put it on the chat if it's okay. It is 1-800-927-4357. Again, the number is 800-927-4357. And also our website is insurance.ca.gov. And you can chat with someone there. If you don't want to talk to anybody, you can easily just, use the chat feature And you can also file your request for assistance online as well, and you can get a contact back very quickly.
Okay, great. Karl, were you going to say something about alternatives for homeowners?
Just briefly, yes. I know we don't want to go too crazy with this, but we used to shop for insurance, right? You'd have options and you would pick and choose, and now we say it's more like hunting. Ready, aim, grab it. And if you grab something, you get something, you take it. I would say that check with an independent broker, check with lots of independent brokers, check everywhere you can. And if you get something, I hate to say don't be too particular, but if you get something and it's with a carrier you're familiar with and the coverage is comparable or you're comfortable with it and it is something affordable, take it, because you might not be able to have that option literally within a day or two. Don't assume that if the quote is offered to you on Monday, that Friday you can call that broker back and get it. Somebody else might have taken that capacity between Monday and Friday.
Okay, great. And thank you. And Karl, I see you have your hand raised. So if you want to add on to that, and I have another question also, which is, can you give specifics about what the FAIR plan costs and what a double plan would cost?
Well, first, I just want to add one more comment to that last point. Was if the case does, if you end up with the FAIR plan, you end up deciding, for your condo or duplex or whatever your risk may be, and you do find out that a new carrier is available on the market and they're offering the HO3 product or a different product, or we're set up. That's our goal. So there's no penalty, there's no short rate. So that's something, again, your broker can help you cancel your policy with a FAIR plan and receive your refund as you get on to a new plan. So again, that's really our goal. That's what we want to see happen. So again, if there's a scenario where you ended up for a period of time on the FAIR plan and now a new option is available, absolutely take advantage of that. You don't have to wait a full policy term to make that move. Okay, and then I'm sorry, what was the first?
That was a great ad. For the FAIR plan, can you just give a ballpark of costs and what a double plan would work like? I know that the FAIR plan only covers wildfire, is that right?
No, it's what's called a named peril policy, so it would cover fire, smoke, explosions, lightning. So there are specific perils that it would cover, and there are some options you can really pick and choose how you want to structure it. So that's something your broker could help you with. So again, that's something you definitely want to consider. And again, I think the benefit there is you can truly pick and choose what's important to you, what aspects are important to you, where normally insurance policies are packaged and the percentages or the coverage amounts are just ratios or rules of thumb. And again, this way you can really customize to have the right amount of coverage in the right areas that are important to you and your property. And again, I think it's amazing. I think in my experience, in these circumstances, the consumers are more educated and more knowledgeable than I've ever seen or imagined in the marketplace. And it's really positive to see that, because they're aware of what they're buying, they're aware of what's important, how it all works. So it's really great to see that reaction as well from the consumer side.
Okay.
And Lori, you had mentioned, just to add that I think the original question was a 4-unit building.
Yes.
As long as the value is under 20 million, they can go to the FAIR plan, right, Phil?
Okay.
Yes.
Good to know. Thank you. Here's another question. Why are non-renewals happening for urban homes that are not in the wildland urban interface?
I guess I'll take it since everyone's rushing for this one. This is one of those things that's the most frustrating, right? You're in the middle of the city, you're not in the brush area, you've never had claims, you've been with the same carrier for all these years. Because of and this is just part of the answer. It's a long conversation if you want to get all the details, but the main part of this is the way insurance companies operate in California. has to do with their market share, and their exposure of market share has to do with how much they're responsible for the risks with the California Fair Plan. So we learned about that a little bit. Phil talked about it already, and I know Amy talked about it as well. So when an insurance company has, let's just call State Farm has 27%, 25% market share in California, if the Fair Plan needs to get money, they will surcharge State Farm 25% of the bill that they need. So right now, carriers are trying to downsize because they're afraid of the exposure based on their market share that they have, that they're going to have X dollars potentially to be as a surcharge coming to them from the California Fair Plan if there's a large catastrophe somewhere. It's one reason. It's a pretty long scope to look at things, to say that, well, we're going to lower our market share because that would lower the percentage that we could potentially be surcharged if there was a wildfire with the Fair Plan. I get it. It's a long stretch, but that's one of the components that comes into it. That's one of the things that we hear during a lot of the conferences that we're having with some industry folk. But in general, it has to do with that concept again, where the carriers just can't be that specific. Again, I'll take a zip code that I'm familiar with. There's one in Southern California. It's 90049. It's actually one of the largest zip codes, I think, in LA County. And half of it is in the middle of the flats. The other half backs up to the Getty Museum, where you might recognize there was a large wildfire, the Getty fire. But the insurance carriers can't pick and choose. If they want to not have the risks that back up to the Getty, they have to non-renew the entire zip code. And so a lot of times that's what you're seeing happening. So again, these are things hopefully that will be addressed with the new regulations coming down, where people that are closer to the Getty, if we're going to stick with this example, will be able to do things to make their homes potentially safer, to keep a policy or to get discounts. And certainly the people that aren't in that exposure at all won't be having any problems getting coverage.
Great, thank you. Carmen, did you want to speak to that one too?
Well, I think my comment was actually in connection with the earlier question, but I would just clarify something. And Karl is the broker and he deals with the companies every day, but it would be very obvious to, the folks in Berkeley who have recognized that their home got renewed, but their neighbors didn't. And 2 houses down did, but the one 4 houses down did not. So the insurance companies are not simply saying, I do or do not insure an entire zip code. They are going far more granular than that. And it is really a red herring for the insurance industry to say, we need models, we need these tools in order to look at the quality of your structure in your home, because they already have the capacity to do that. They're simply choosing not to. So these private models that we take issue with, because we do not know how they're making the decisions they make and how they're reaching the price decisions they want to make with them, are not necessary to take into account. It's just the insurance industry's preferred way of doing it.
Okay, thank you for that. Amy, I'll give you the final thought on that one.
It does go back to what I was saying earlier about the technology. They're looking at older, urban areas. They don't want to insure older properties. That's a big one. They're nervous about, they won't knob and tube wiring if you have old electrical. And the insurance industry is very paranoid as a whole about water damage claims. And so that's part of the reason that urban homeowners are having some of the problems they're having. It's this TMI, too much information, that insurers now access, that makes them have an overreaction to being willing to take that risk on for money.
Okay, great. Right now, people are getting denied coverage because of density. Can someone speak to how that's defined by carriers? I see Carmen's hand.
I mean, my answer is no. None of us can, because they don't tell us. And so that's a real frustration that the companies, we saw it with State Farm. We were able to get granular level data about who was getting canceled, but we did not get an explanation for why those people were chosen. And one of the answers was density. And insurance companies, we think, number of policies in the area, but it could just as easily be how close you are to your neighbor. And the companies are not explaining that. And the Department of Insurance is not requiring them to, and that's a problem.
Okay, Thank you. I have another fair plan question. Someone says, please explain that it only covers fire. It doesn't cover all the other things a home insurance policy needs, like from break-ins or water damage or plumbing, etc. Maybe, Phil, you want to make more clear that plan? Or spell it out, I guess, so we're all on the same page.
I mean, just to keep it simple, if you look at a typical homeowner's policy, which is a package, it's called HO3 policy, and it covers multiple perils, so multiple causes of damage, in more simple terms. And the FAIR Plan specifically covers, it's a named peril policy, so it covers specific perils. You can basically pick and choose, for the most part, what aspects are most important to you. It's customizable. It's the model. It's a framework it was established with, and basically the three main components that are not part of it which would be in a normal typical HO3 comprehensive HO3 policy, would be the liability coverage, water damage, and theft. But same as you would look at you would buy an earthquake policy separately. You'd buy a flood policy separately. So you really look at your individual needs, and you're basically on an a la carte basis, more or less, you're only buying what you need. And I'll give you an example. A lot of times with an HO3 policy, there's percentages of coverage, or there's items in there that would never apply to your property or never apply to your house, but you're paying for it because it's part of the package. So again, I think a benefit to the way it is set up is you really are buying, it's an expensive model, the policy is, but you're buying exactly what you need, or exactly what you want, or exactly what's important to you, more or less. So again, it's important to walk through those pieces with your broker specifically, because there's not a cookie cutter for your home, for covering your home, or what's important to you. It's really specific to you and your family. So those are, again, another reason why I would encourage you to sit down and look at your individual situation, your needs, with your broker.
Okay, thank you. I see a couple more hands. I saw Carl. I saw yours first.
I just want to add quickly to what Phil was saying. Fair Plan has got some great stuff on their website that explains really what they cover and what they don't, to the extent they have little puzzle pieces of what piece it has and what piece it's missing. And on the actual proposals that you'll get from the Fair Plan, when you get a proposal, it's even on that. So they really do a redundant and good job of being sure that you know exactly what it is that's included and what it is you should be looking for. So if you're not sure, you're not picking it up from today, if you go on Fair Plan's website, you can poke around pretty quickly and find, what does it cover and what would you be lacking if you're just purchasing policy from them.
Great, thank you. We've gotten several questions about losing your home if you lose coverage. So someone has a reverse mortgage, they're wondering what's going to happen. Maybe I'll do them. And the other one is kind of like, is there like what's the time between getting a non-renewal notice, losing coverage, and then the mortgage lender calling in the loan? Oh, I see Amy. I see you. Sorry.
Yeah, I mean, you're more likely to have them force place a policy than to call in the loan, right? So that's the whole system they've got set up. And then they're going to tack the premium for the force place or lender place policy, same thing, onto your debt. So it makes you go deeper in debt. I don't know about lenders calling in loans. When people say they're afraid they're going to lose their house, if they have a mortgage, their option is this craptastic product that the lender will put on. And that's one of the reasons that we, United Policyholders, has been pushing the Federal Insurance Office and the regulators to do a nationwide data call on how many people are have fallen into forced place policies, how many people are going with these unregulated surplus lines. We don't know the answer to that. But I don't think that the loan would get called just because you let the insurance lapse.
Okay, great. Thank you. It's a little more helpful. How how does the state of California regulate rates that are based on models or machine learning?
We are, that's what we're working on right now. And that's what we are looking at, we're getting all of the experts on this. And so it has been a process where we are doing research and we are getting input from all of the different modeling experts as well. But the department is doing extensive research and extensive work on this to make sure that we are able to get the best product that or the best policy that we can potentially get. And so we are asking people who are familiar with all of this as well to get involved, go to and be a part of those workshops, get us information that you have as well or that you might be involved in. I know that there's a lot of expertise in this community as well in different areas, and this is something that is that you are familiar with. We absolutely want to hear from you. So we are holding our workshops, and so we hope that you will get involved in that as well.
Thanks. I saw one other hand.
That was me, and Julia answered half the question, which is that we don't regulate them at all yet.
Okay.
The department is proposing a regulation that would create a very truncated process to oversee private models in the future. From our point of view, that procedure, as it's proposed right now, the regulations are still in development, but it completely lacks the transparency that is the basis of rate regulation in California. And so we urge anyone who wants to know what the real impact of these models is on their rates to participate in those proceedings, and urge the commissioner to move towards more transparency, because we think those regulations really fall down on that point.
Okay, thank you. A little bit related, what power does the insurance commissioner have to enforce the regulations? Like if they drop somebody for a spurious reason and refuses to discuss it, does the commissioner?
So there are the insurance, the Department of Insurance is responsible for regulating the industry as a whole, and so what we follow is is all of the regulations, the insurance code. And as Karl mentioned earlier, the insurance code is a book about this big that has just a lot of different rules there. If you happen to feel that that you are being dropped unfairly, or if there is something if you have any type of issue, that is why we have our complaint process available within the department, so that we can help you navigate all of this and figure out, are they following the regulations? Are they doing everything correctly? And so I urge you to contact the department. Our website, insurance.ca.gov, we are able to our experts are able to find out what your what your issue is, and go and look at very specifically what your premiums are, and everything in detail that you might need to see that. I know that many of us, when I purchased my home, when they gave me a set of 30 pages to sign, I did not sit there and try to read every single detail on this. And so there are things that we can do that we can walk you through that. And so I urge you to please contact the department, and we have our experts available who can help you navigate through all of this as well. So the easiest way and the quickest way that I would suggest also is just our website, which is just insurance.ca.gov.
Thank you. That's great. I have a few more. I mean, there's actually 141, but we'll just do a few more. So this person writes that they're leaning towards going with, quote, non-admitted carrier to better distribute the risk. but now our carrier has offered to retain our policy in conjunction with the FAIR plan. Can any of the panelists walk us through the pros and cons of non-admitted carrier versus the importance of sticking with their long-term carrier for possible benefits? And I saw Amy's hand first, so let's go to Amy.
Sure. I'll take a little of this, and I'm sure, Karl can elaborate. So, United Policyholders has been around for over 3 decades, giving people advice. And we would never, until this crisis had gotten to the point where it is now, suggest that a consumer go to a non-admitted carrier over a brand name admitted one. And that's because the non-admitted companies, they have, in insurance, there's always like 3 words to describe the same thing: non-admitted, surplus, excess, all the same thing. All right. We would never have sent people there because they're not protected by the California Guarantee Association, which is the fund that says if your insurer runs out of money to pay claims, you still have something behind it. These non-admitted companies, you're without a net there. So if they run out of money, you're out of luck, right? But these days, for some people in some situations, a policy through a surplus lines or non-admitted company may be the better deal than the FAIR plan. Plus FAIR plan plus a difference in condition is maybe more costly for you than just buying through a non-admitted and getting the package. So, for us, as a consumer advocate, we offer people guidance on how do you check the financial strength of a brand you never heard of. And it does these days, we say you got to work with a really good broker, because the brokers know their way around the players. There's a lot of names you've never heard of. And Delos is coming in, are they okay? So I'm going to turn this over to Karl or Phil, because again, this is a new normal here. This is unprecedented times. So we are now open to this idea that a surplus lines policy might be better than FAIR plan plus DIC, difference in condition. It's often definitely better than just a FAIR plan on its own. So Karl?
Yeah, you really summarized it really well. The one thing you can do also is there's no guarantee, there's no steadfast rule for either one, because you might have thought, 6 months ago that, well, of course, if you have the choice to stay with State Farm, you should do that. State Farm's financial rating in California now is a B, which sounds not so horrible until you realize that you start out at A+, A minus, B+. So to get to B, you're really sort of far down the line. So one of the things you want to check is, if you are going to work with a non-admitted company, like Amy was saying, is there are ways to check their financial stability. For example, Lloyd's of London is a very, very well-known non-admitted company. There's also a list, and Julia probably can speak to this better than I can, called the Leslie list. It's the, if I can remember, a list of excess and surplus lines insurers. I think that's what it actually stands for. Wow. And that's a list of non-admitted companies that the Department of Insurance has looked at and said, okay, these are not admitted, we don't support them, but we've looked at them and we don't think they're so bad. And that's probably a very strong overgeneralization, but that's the gist of it. So I think if you're going to be looking to go with a non-admitted company, you want to first check with the Department of Insurance, and then perhaps look at that list also and see, is this carrier on that list? Have they at least been looked at, or are they literally just an unknown quantity that's decided to throw their hat in the ring and try and make some money when times are tough in California?
Great, thank you. How are we doing on questions and time?
It's 8:45, and so we have time for a couple more.
Okay. Let's see, which one should we do? Here's one that's pretty specific. It says, what is the logic for Versic fire line for wildfire risk score values to be 0 for negligible, 1 to 2 for low, 3 for moderate, 4 for high, and about 13 for extra high? Why is 90% of the possible score range for high and extremely high? Amy.
So as you might have heard Julia say earlier, and I think Carmen referenced it as well. We now have a rule in California that if an insurer turns you down, they have to tell you what your risk score is, and then they have to give you a process for appealing, right? That's something that the commissioner put into effect. The challenge is like the different risk scoring systems use different numerical values. So like Fireline 1 to 30. And a lot of insurers have said 3 is that's our sweet spot, or 5. Verisk, or some of the other programs, some of them go 1 to 100. And again, this is one of those areas where consumers are at a big disadvantage because we don't actually know what goes into the score and why. And we're starting to ask insurers to tell us. That's what the reg is about. But I think we still have some work to do there because we don't regulate those scoring models. There's a legislative proposal to regulate them that's pending. I think other people might want to add.
Okay, I see. Thank you. I see Carmen's hand.
I mean, on one level, I'll just say what I've said before. That's a really good question that we can't answer now, and we need greater transparency for. The modeling companies like Verisk have been very clear that they refuse to explain fully how they got to that point, which is why we're urging a public model. But I would also just point out that that big variety that Amy also mentioned, we have a number of different companies that offer various different wildfire scores. And then there's a new problem we've run into. Companies that are not using what they call a wildfire score. They're just wrapping in their consideration of wildfire into their territory rating. So you give them your address, they punch your address in, they say, this is what we charge you. And when you go to them to challenge it and say, oh, well, why did my rate go up? They say, oh, because your address is this. And that is the only explanation they give you. And we've heard that from a lot of State Farm policyholders. They don't use a wildfire score. They wrap the wildfire score into their territory rating, what your zip code is, your address, and then they give you a price that way. Well, we petitioned the Department of Insurance to say, State Farm, you have to explain that too. Just because you don't call it a score doesn't mean you're not rating people on wildfire risk. And the department rejected that petition. So I think it's an example of insurance companies already trying to get around the rules that the department put in, in good faith, trying to get consumers more answers. And now they're not giving us those answers. That's why we need a lot more accountability from the insurance companies, and why we're urging the department to impose that on companies.
Great, thanks. What is the specific law or rule that requires the insurance carriers to tell us why they're canceling coverage? I know, Julia, you had mentioned it, but do you have a?
Well, I know that we have, when we discussed the Safer from Wildfires framework for mitigation, and sorry, what was the?
I was asking, like, the law that the Commissioner Lara put out to have it that insurance companies need to state why they're canceling coverage. Is that like?
I think she's talking about the Fireline, the scores that he put out.
The risk score, the wildfire risk score. And that is a regulation that was done last year. That was a part of the Safer from Wildfire framework as well. So it was all done there. I will have to look for the very specific thing. I will let me find that, and I will put it on the chat here as well.
Okay.
There is in the insurance code, there in our statutes actually, that says the insurer is supposed to give the reason, but it's already in there. But it's pretty general. They can just say wildfire risk, or they can say doesn't meet our underwriting guidelines.
Okay, great. Any thoughts about AB 2996, the California Fair Plan Association bill? if it's gonna pass?
Phil, do you want to take that? That's the bill that would let the fair plan go to the iBank and float bonds.
Yeah, that's not my area of expertise. I'm gonna go ahead and pass on that one.
I mean, it got pretty significant support thus far, didn't it? But I don't know if it passed off the floor yet.
I don't know. I know that there's a coalition supporting it. The developers, building industry, realtors, Farm Bureau, looking for a way to be able to get the fair plan to be able to insure. Right now they insure up to 20 million per location. And what this bill is designed to do is to give the fair plan the ability to insure up to 20 million per building, which would be very helpful to large condominiums, apartment buildings, etc.
Carmen, your hand is still up.
Well, I was gonna make a slightly tangential point, but it kind of goes to why we have the that bill 2996, which would essentially give the fair plan a way to shore up its financial stability. And the reason we need to shore up the fair plan's financial stability is because it has more policies than we ever expected it to have. And that's because insurance companies are canceling and non-renewing people. So the real answer to this crisis is to get people out of the fair plan and back into the regular insurance market. That's why we have urged a mandate that requires insurance companies to insure only the riskiest or the least risky people who have done the right things to harden their homes. But I was hoping that the Department of Insurance would talk a little bit about their plan, because they talked about a lot of things that they have proposed that the insurance companies are demanding in order to come back into the market. But there's only really one thing in their whole plan that is consumer oriented. And that is this idea that insurers have made a commitment to come back into the market if they get all this other stuff that they want. And there's a real question lingering about that commitment. And the question is whether or not insurance companies will be committing to sell real standard full policies, or if they will be allowed to sell a limited benefit policy like consumers can currently buy in the FAIR plan. And I think that's really critical because, as many of the folks who have been commenting, they're really frustrated with being shoved into the FAIR plan. They want access to a real policy, especially when they've done all the right things. So I would love to hear from the Department of Insurance on whether that commitment is to sell a real standard HO3 policy.
That is the expectation as we are working with them. When the Department of Insurance has been working on this issue for quite some time, and actually, we have really engaged all of the different stakeholders in this conversation, specifically because of that, because we know that there are there are major needs and major issues within the industry right now to make sure that the market in itself is stable. We have seen, the great losses that the fires of the 2017, 2018, and all of that really have just devastated the industry as a whole. And so we are working not only with the industry, but we're working with all of the different stakeholders to make sure that we understand fully the problem, but then that we come up with solutions together. And that is why we very much so have been engaging in getting everybody around the table. And that is why insurance companies are saying they are coming back to start writing. They're not writing quickly enough. They are not, of course, because we're in the middle of all of this. When you hear, that there are some insurance companies that are dropping, the State Farm is dropping a very large number of folks. Well, you got to understand the State Farm, 21% of the market in the state. And the next one, next to it was Farmers coming up at 14, and then everybody else came in at 6% of the market, or even lower. And so the way that we need to that you will be able to get more competition is if we get more people selling insurance throughout. And so that is when we are coming in with these are all the different things that we are going to work with you on to make sure that that consumers, that you are able to see, you know, exactly what the risk is. You are able to get through, you know, all of this, you know, you're able to get through you know, the very specific granular level to see those communities that are doing the work. Then you will be able to see where the risk actually is and be able to actually price it correctly. So the expectation is that when that happens, that then insurance companies will be able to then get people out of the FAIR Plan. We are moving in that direction. We're getting you know, that is the work that all of this is going to do, is getting not only just the catastrophe modeling in place, but then everybody really working together to make that happen. And right now, you know, you haven't heard us really talk about, bless you, Amy. You haven't really heard us really talk about affordability right now, because right now what we're working on is availability. We want to make absolutely sure that people are able to purchase insurance. And so that is why all of this is coming together.
We have to wrap up.
Sorry about
Yeah,
that.
that's great.
I just, we have a couple of minutes left. Very, very briefly, like maybe 30 seconds, I'd like to leave the audience with very specific advice. So I'm going to go around the screen and call on people and pick the most important thing you think people should do. We'll start with Phil.
My time's ticking away on mute there. You know, one good thing, and I just want to piggyback on what Amy said earlier, is just commending all those you that are part of Firewise communities or active with your fire safe councils or fire alliances. You know, I'm all over the state and I see a lot of hard work, and that really is meaningful, and it does translate to discounts when it comes to the FAIR Plan. So again, there's from the home hardening and defensible space discounts, that's up to 14.5%. And then the Firewise discount is 10% off of the brush surcharge portion of your premium. So again, those are really big discounts, a community-based discount, and those are all very tangible steps to make your home more fire safe and also your home more insurance worthy down the road as well, when carriers continue to look at attributes of your home or your community for future availability.
Thank you, Phil. Okay, Carmen.
I would say contact your public representatives. Ask them to support a public model so we actually know what these models are doing. Ask them to support legislation that would require insurers to cover people who do the right thing. We already do it in auto insurance. We already do it in home insurance. We need it in or health insurance. We need it in home insurance. And to ask for assistance with mitigation. The state does some, we need to do more, and we need to be making the insurance companies pitch into that, especially since they're insuring fossil fuel companies. They should be helping us mitigate the damage they're helping cause.
Thank you, Carmen. Amy.
So raise your deductible. I carry a 5,000. That's a good way of bringing the premium down. Reduce or eliminate coverage that you can live without. So like high dollar limits on your contents. Maybe you don't need that much on contents coverage. Work with a really good proactive broker to get any other strategies. And then do what you can to reduce risk. I mean, if not to get insurance assurance, at least to save your home and make it less likely to be damaged.
Thank you. Karl.
I would say don't wait. Start right away. If you're getting non-renewed and you have 90 days, don't figure you'll wait till day 80 to start looking. Start looking right now. And if you can get a policy right now, even if your existing policy doesn't expire for another 30 or 45 days, buy that policy the moment you have the availability to buy it, even if it means having double coverage for a short period of time, or you can try and cancel your old policy. But start quick, start early, check around a lot, and take what you can get when you can get it, and don't wait.
Thank you. Colin.
Work with your neighbors to mitigate the hazards so you don't need this insurance. One, defensible space. The easiest, simplest ones to do, the cheapest ones to do are the most effective. Home hardening. The simplest and cheapest ones to do are the most effective. Thirdly, work together to form a Firewise community or a collection of people so you can demonstrate to the insurance agency a regional approach. And then fourth, I'll share our email, which is wildfire@berkeleyca.gov. If you got questions about what we talked about tonight as it relates to defensible space and fire safety, please reach out.
Thank you, Colin. Okay, Julia.
I just want to make sure that people are aware that they can contact the Department of Insurance for any assistance. We are at 800-927-4357. If you are part of a Firewise community, you are also able to apply for grants that will help you to continue to do that mitigation. And so I encourage those who are not part of Firewise communities to get involved in that as well.
Thank you, Julia. Okay, I want to thank you all so much. Tonight, you shared so much information, an incredible service to our community. I've learned a tremendous amount, and I hope our attendees have as well. So thank you again. You all did an amazing job, and I'm very appreciative. Thank you and good night.
Good night. Thank you.
Everyone.
Good night.